we go. Welcome everybody. It's about to get popping. It's about to get lit. It's about to get popping. Go ahead and come in. Shout out your city in the chat. Shout out where you're from in the chat so I can know where you're from. If you're from a different country, let me know that as well. We're about to get into this, y'all. We're about to get into this. We're about to drop some gems. We're about to answer some questions. We're about to tell you all the really cool things that are going on in the stock market. You know, this is my favorite time to be investing in the stock market. When the market is down, when the market is tanking, when people are scared, when people are fearful, man, I love that. That's my favorite time to be in the stock market. I don't like the hype. When the stock market is getting real hyped up, that's when I just be chilling. But now it's nothing but opportunities. There's a ton of opportunities in the stock market. I want you guys to be prepared for these amazing opportunities to make some money. We got Nairobi, we got Savannah, Georgia in the building. Where else are y'all at? Shout out where you're from in the chat. I think the first and the most important thing to talk about before we even get started is that none of this matters if you aren't going to do the work and you aren't going to study. There's no such thing as a free lunch, not even in the stock market. No such thing as a free lunch. So you got to make sure that you are willing to do the work, that you are going to put the time in, the energy in, that you are going to put the practice in, that you're going to continue to do the continuing education. My mom's a CPA. Shout out San Antonio. Shout out Las Vegas. Shout out, where else we got? I saw somebody else in here. San Pedro, that's right down the street from me. Phoenix. Yeah. So a lot of opportunities in the stock market. But again, do the work, y'all. You got to do the work. Let me go ahead and get my slides up. We're going to get right into this. Maybe if I do it this way. So you guys on Instagram can't see the slides. You should have registered for the webinar if you want to see the slides, but you're gonna still get this game. You're gonna still get the lesson. You're gonna still get the information. You just won't happen to see the slides. If you want, you can catch the replay. You can do all that cool stuff. But we're gonna get to it, man. I'm hyped. Y'all understand? I'm turned. Like Kanye said, I'm turned right now, man. So we're about to get it in. And the very first thing I have to let you know is that I'm not a financial advisor. At one point in time, I was a financial advisor, but I'm not currently a financial advisor. So this information is for information and education purposes only. If you want information that's specific to your actual circumstances, please contact a financial advisor, and they'll be able to help you out with that. But the information that I'm going to give you should allow you to kind of function as your own financial advisor. If you follow these steps, if you continue to do the education, if you continue to dig in, if you continue to practice, if you continue to get out there and take trades, you are going to be great. So who am I? Who is Charles Todd Oglesby? A lot of people call me Todd, but my name is Charles. Todd is a name that I created a long time ago, and it's kind of stuck with me. It really was a brand for a necktie company. Started a necktie company. I called it Hunter Todd Neckwear, and I realized I don't have a passion for fashion. I have a passion for business, but I wasn't connecting the two because in order to really be good at this stuff, you guys, in order to be really good at business, in my humble opinion, I think that depending on the industry, depending on who you are as an entrepreneur, there has to be both a connection to you as an individual and entrepreneurship. So people see me posting 12, 15, 20 times, 30 times a day. That's because I really live this stuff. If I'm not talking to you guys, I'm watching YouTube or I'm reading a book or I'm doing something along those lines. I was sitting there last night reading a book on options trading. Right here next to me, I got a book on the blockchain. I got a book on cryptocurrency. I got 2 books on cryptocurrency, 3 books altogether. I really live this stuff. And so you know what? I was at a wedding one day and somebody said, hey, man, I see you got a necktie company. You into fashion? And I was kind of like offended. I was like, I'm not into fashion. But I feel like if I was into fashion, if I was really into that stuff, I could have really blown that business up because so much of a business is bigger than just the product. When you're building a business, when you're building a brand, when you're investing, when you're in trading, it's bigger than just that thing. You got to start looking at all these things that surround that. What are things that are going to build what you're doing that have nothing to do with that product? It might be a webinar. It might be a podcast. It might be a blog. It might be social media. It might be going on somebody else's podcast. And if that's not your lane, you're going to have a hard time to succeed in that. Will you be successful? Maybe. Probably so, but it's a lot easier to be successful when it's your lane and your space. So I wish I could see the chat, but I can't. So shout out to everybody who is here. Who am I? Law school graduate. I have a Juris Doctorate degree. I'm getting my MBA right now, past financial advisor, Series 7, Series 66 financial advisor. I was selling individual stocks. I was selling mutual funds. I was selling ETFs. I was selling life insurance. I was doing all that really cool stuff. And I had a good time. I learned a lot. And all the information that I learned in working for that company, Edward Jones is a very conservative company. They kind of instilled in me this understanding of quality companies. When you work at Edward Jones, you're not even allowed to pitch certain companies um, to people unless they're vetted by Edward Jones. So the back office vets the stocks, and then they say, okay, these are the companies that you can recommend to your clients. And I was kind of taken back by that because in my thinking, I was like, man, there's all these other really cool companies out here that I would like to invest in, or I would like to tell people to invest in, but I can't recommend those because you guys don't let me recommend them. I ended up circling back to that concept, and that's why you guys will hear me talking about a lot of companies. And there's companies I just won't look twice at. There's certain projects, certain new securities that are coming on the market that I don't look twice at because my training at Edward Jones just taught me quality matters, longevity matters. And when you're buying a stock, it's like Warren Buffett says, buy it as if you're going to hold it forever. Our favorite holding time is forever. So in this webinar, you're going to get a combination of trading talk and investing talk. I think both they're lucrative. I think you can make money doing both. Yes, trading is sexy, but so is just flat out investing in the stock market. Do not turn your nose up at investing in the stock market just because options trading exists. A wise and intelligent investor does both. You want to trade and you also want to have long-term positions. So I worked as a private client banker after that. And with that, it was really cool because I got exposure to even higher net worth individuals. So now I was working with people who, I mean, granted, as a financial advisor, you're working with people across the board. But when I went into the private client space, I exclusively worked with people who had over $250,000 in assets or more. And I say or more because most people had or more. And so, but man, it blew my mind to see people with money I'd never seen before just sitting in their savings account, the income they were making from their jobs. It was just insane. So it was definitely an inspiration to me and also kind of gave me some direction on how I should conduct myself if I desired to be at that level. The company that I run is called Tide Capital and Affordable Education. We teach people how to build wealth without breaking the bank. That's a gem. Man, I got to tweet that. We teach people how to build wealth without breaking the bank. I found that when you keep your products affordable, you can touch so many more people. So it's really cool when I'm traveling across the country, when I'm going different places, and I'm seeing all these really cool people that have been impacted by my content in some form. I'll never forget, I was at the Eric Thomas conference, and Eric Thomas has a podcast. I listened to his podcast. I'm sitting next to a guy. He might be on this thing right now. He might not be. I'm sitting next to a guy. We sat next to each other for maybe like 3 or 4 hours. And then like at hour 4, he was like, hey, man, I love your podcast. And I was like, that's crazy. Like this whole sea of people, and I'm sitting next to somebody who listens to my podcast. So that was really cool. I love the impact that I'm making cross country. So if you ever see me in these streets, shout out to me. Let me know that you rock with me. And I'm going to probably make you give me a video testimonial because that's part of the exchange. We're going to have a conversation, but I got to get that video testimonial. I made over $700,000 in stocks in 2020. It was a fantastic year. Man, we were running it up. And I think what I found is that the stock market oftentimes moves in waves. So if 2020 wasn't that great of a year, or if 2020 was a good year, 2021 might not be that great. 2022 might be very good. So the stock market moves in waves up and down. And then, of course, the claim to fame. The way I really got started making real money in the stock market was trading options. My first year trading options was 2018. I made $20,000 in a few months, and I made over 100% return on investment, or 1,000% return on investment. I was blown away. I took a small account of about $2,000, turned it into $20,000, bought my wife an engagement ring, and she was happy. So my stock market investing story starts as follows. Like I said, I started working at Edward Jones. That's when I opened up my first brokerage account. And I just wanted to kind of like try this whole stock market investing thing out. I've been sitting there watching CNBC. I would just immerse myself in CNBC. And you know what? I had no idea what they were talking about. So what I would tell you is that you got to be immersed in that space. Turn on CNBC. It might sound like gibberish to you now, but the more you watch, you're going to start to see patterns. You're going to start to see the same things coming up. You're going to start to see different companies, different reactions, and all that stuff's going to help you become a better investor and a better understander, a better person who understands more of what's going on in that space. So immerse yourself in it. I definitely recommend. What I did is I was just watching CNBC. That's all I did was watch CNBC. And then I got the desire to buy some stocks. I had some extra cash. I was out of college. I was working a full-time job. I was living at home. I had some cash. So I bought some stocks. And I bought Bank of America stock, and it didn't really do much. It just kind of sat there. And that was one of the things that I don't like about quality companies is sometimes they're boring and they're stable and they don't do much. On the other hand, you're not going to risk much, but your opportunity to gain is limited. So I wanted to figure out how to make more money. So what I did is I would look at the stocks that were moving. So I would see companies where if you look at like Robinhood main page, it's going to show you like those movers. If you look at certain screeners, it's going to show you top movers, top gainers, top losers. I would buy the top gainers and I would get clapped. Why? Because again, the market moves in cycles and waves. If you buy at the top, because you see the green, what's coming next? That next downturn. And so I didn't want that to be me. And so I was like, all right, I got to go back to the drawing board. And so what I did is I got in the library, man. I'm a reader. I'm somebody who I learn everything through reading. And so I was a heavy reader. I'm kind of a light reader now, but I need to get more into it. But I went in the lab and I started studying like the most successful investors. I read a bunch of Kramer books, read a bunch of Peter Lynch books, a bunch of Warren Buffett books, and I read my favorite investing book, which is A Random Walk Down Wall Street, which in my opinion is like a textbook on finance. Every single thing that I learned in finance was covered in that book, Random Walk Down Wall Street. So what I started doing after I was losing is I started trading penny stocks, and penny stocks just weren't doing much for me. I put like $100 in penny stocks. It rose and it fall. It wasn't really that appealing. So I just kept at the drawing board. I was like, man, people are making money in the stock market. I got to figure out a way to make money in the stock market. And I think this is important because I've done all of the digging for you. I've tried all these different methods and I landed in options. I landed in value investing. And those are my two most proven methods to invest and trade. So when I'm trading, I'm looking at options. When I'm investing, I'm looking at value. So what I was doing is I started trading earnings, swing trading earnings, and I'll put my entire portfolio behind the position. And usually what you'll see is like a position will gain, like today, for example, Amazon fell 10%. And so I was like, this is great. 10%. You don't get that on an average day in the stock market. An average day in the stock market, you're going to get about 1 to 2% on average. And I noticed that around earnings times, you get those huge pops. And so I would time the huge pops. But what I would do is I would shift my entire portfolio behind that one holding. And I was doing pretty well. I mean, I only really missed like maybe like 1 or 2 trades, and I was hitting like 10 to 15 trades that I was in. And I was like, okay, this is cool. And then I ran into one of my old business partners, and he was like, man, I'm trading options. You should try this out. If you're doing this, it could work better with options. Tried it out, and I never looked back. The most important thing when you're trading options, and this is so important because, like I said, none of this matters if you don't do the education. None of this matters if you aren't studying. None of this matters if you're not binging YouTube content and investing in courses and investing in these different Discord groups and doing things like that. You got to find your why, and that why is going to pull it out of you. That why is going to have you up at night watching what you need to be watching instead of watching what you want to watch, watching and reading what's going to help you elevate instead of reading nonsense or watching more nonsense or just going to sleep for that matter. So you got to tap into your why. My why was I wanted to buy a new engagement ring. We got married. I bought what I could afford in that moment, no job in law school. And it was kind of embarrassing. And that embarrassment drove me to really grind and figure this thing out. So I would encourage you to find your why. And at this point, I would encourage you to type your why inside of the chat. What is your why? Why are you driven to stock options? Get it out in the open, because if your why is just money, I'm sorry, but that's not a strong enough why. Your why has to be something that's attached to what the money can bring you. So what is your why? Drop that in the chat. What's your why? What's your why? And I'm pretty sure a lot of us have the same or similar whys. It can be your kids. It can be education for your kids. It can be getting a new car. It can be whatever. Let's find out what these whys are. Time freedom. I love it. Rental properties. His son. What's your why? Cash flow and freedom. Why do you want cash flow and freedom? Why do you want time freedom? Opportunities for your children. Family freedom. Buy your mom a house. I love it. I love it. I feel like our whys a lot of times are attached to the people that we love. They're attached to the people that we love. And it's not about just getting a car, man, because cars don't talk. Cars don't have feelings, time and family, own your time and generational wealth, retire your mom. Those are what's going to drive you, man. Leave something greater, generational wealth to my lineage. I love it. So, man, everybody talks about options, but now we're going to talk about what options can do for you. This right here was 145% in return. Let me see what the actual, it's not showing me what the actual purchase price was, but let's say it was about a $500 investment. The $500 investment brought $1,277. This right here, this is 137% return. Let's say it was like a $200 investment and it brought back 550. I think my math's a little bit off, but the power of options is the leverage and the ability to make life-changing money that can pad your savings, money that can allow you that time freedom, because a large part of time freedom is having money in the bank. It's very difficult to have time freedom if you don't know where your next meal is coming from. It's very difficult to have time freedom if you got to go give up all your days to make money to pay the mortgage. It's difficult to have time freedom. And what I like about these numbers, this $1,000 number, even this $500 number, is the average person, they say, doesn't have $1,000 in savings. And that's because they ain't trading. If you're trading options, you can make $1,000 a lot easier than if you were to work money and make $1,000. And all it takes is your mind. Let me tweet this. So here's another example of a successful trade. Total return, 1,300. So this is a total return. This is the money that you made on top of your initial investment. So you put up what you put up. Maybe it was $1,000 that I invested. And this is a way bigger return. This is NVIDIA. This is a monster trade. So this person made 640%. So they probably put up maybe like, or 764%. They probably put up like 100, 200 bucks and made 1,300. The power of options. I say you can turn small money into large money with options. So this is important because just because you have large money doesn't mean you need to invest large money. And also, if you have small money, you should be doing everything you can to understand this principle, to practice this principle, so you can start seeing $1,000 gains. $1,000 gains, in my opinion, is a large part of the goal. We want to make that $1,000 because most people don't have $1,000. So if we can make $1,000, now we're looking good. Now we're seeing some success. And then this one was a monster trade. You guys all know Chris Johnson. He paid $3,900 for this contract, and he made about $11,000 off of a $3,000 investment. This person here made a $400 investment and made $1,300. So the leverage is definitely there, and that's what makes options so beautiful. So basic stock trading terms, you're going to see these things once you start. Yeah, I'm doing two different things. So if you guys are on the actual webinar, you can see the screen. If you're watching on YouTube, you're going to see the screen. If you're watching on the Instagram, you just get to see my face. Shout out to my face. So these are important because a lot of times people get into trades and they have no idea what any of these things are. They don't know what a limit order is, a market order is, a day order, scaling out, scaling in. But I think the most important thing is going to be your limit order, your market order, your good until cancel, and your day order. Somebody said options trading should be taught as an elective in inner city high schools instead of driver's ed. A limit order is, it can either be a buy limit order or a sell limit order. And basically what it's saying is you're going to make that order. You have to specify a price. It's going to execute your purchase or your sale at the price that you specify or better. So better is determined by whether you're buying or you're selling. What's better when you're buying? Do you want to buy high or do you want to buy low? When you're selling, do you want to sell low or do you want to sell high? So a limit order, if you have a buy limit order at $100, you're either going to buy it at $100 or less. If you have a sell limit order, you're either going to sell it at $100 or more. And so this is important because options move really fast. Those valuations, those numbers are just whipping across. Why? Because the leverage effect. The leverage effect means that a small move in a stock means a big move in your contract, either up or down. So that price is constantly whipping back and forth. You have to specify where you want, because the other side of that is a market order. A market order, basically, you just take whatever they executed at. You would hate to have profit put in a market order and they just sell it at whatever number, and the market and the stock happens to whip up really quick, and now you're losing money on that trade when you really made money. So understand the difference between limit orders and market orders is so important. The next thing that I'll say is good until canceled order or a day order. This is important because the market moves intraday. So what you're going to see is, if you look at a stock right now, you're going to see after hours trading and you're going to see before hours trading in the morning. The problem is you can't participate in the after hours or before market trading. You just got to watch. And so you don't want a lot of your positions to be stuck in overnight, especially when you're trading, because we don't know. We had a great day today in the stock market. It might get hammered tomorrow. And so you don't want to carry that position. You want to have a day order so that then the day order, if it does not execute by the time trading hours closed, it cancels it. A good until cancel stays until you cancel it. And they're going to give you this option. So if you're trading in Webull, Thinkorswim, whatever's out there, TD Ameritrade, Scottrade, you have to specify, is this a day order, good until cancel, is a limit order, or a market order? Usually with options, they only give you the option of doing a limit order because they know that options move really fast. Scaling in, scaling out, averaging up and averaging down essentially is just saying that you're increasing your position over time or decreasing your position over time. And that's a strategy that I use a lot when I have a good feeling that a stock is going to do well, but I still have to mitigate my risk by not putting all my capital at risk. And so what I'll do, for example, with Tesla, when Tesla split, I thought it was a good opportunity. I bought some at that point, but I bought just a little bit. And then I let the market kind of tell me where it was going. Is it going to be a positive or negative reaction to the split? I still want to take advantage of the split, but I didn't want to tie up all my capital. It proceeded to tank. And when it tanked, I put the rest of my money at that next base. So I was looking for that base, and that's when I hopped in. That's a version of scaling into your position. And the same is true when you're taking gains as well. Sometimes it's good to let some winners run, but take some profit off the table. So that's what scaling out would be. All right. How options work. So very important slide. And the very first thing I'll tell you is that options are a derivative. A derivative is a financial contract that derives its value from the value of another asset. So you buy option contracts on a particular stock. You don't just buy options contracts for the sake of options contracts. Thankfully, this is what makes options contracts easy to understand, because we're buying stocks in companies we use, know, love. Right now, you're probably sitting on, around you is probably 10 publicly traded companies. Apple, Sony, Gatorade, whoever owns Gatorade. I think Pepsi owns Gatorade. I'm not sure who owns Gatorade. I don't know if it's Coke. I'm pretty sure it's not Coke. But one of them dogs owns Gatorade. Gucci. What else around here? LG, HP, whatever this company is. We're sitting around a bunch of publicly traded companies that you know the value of. We determine what's hot. We know if it's a good stock, if it's a bad stock, if it's a great company, if it's popular, if it's losing popularity. These things matter. And so if you love Apple products, if you love Tesla cars, if you see people buying a bunch of homes and there's home building going on, that's an indication that that stock is going to probably increase in value. So that's one point. The next point is that an options contract is equal to 100 shares of stock. One contract. So when you're buying options, you're buying a contract. That contract gives you the right, but not the obligation, to either purchase or sell a particular stock at a given period of time. Each option contract has an expiration date and also has a strike price. That strike price is where you're saying the stock is either going to be at, above, or below. So some people buy out of the money options, in the money options, at the money options. That's all based on the strike price as it relates to the current stock price. So you have a strike price that's going to show you, let's see, like if I were to go back here, current price, average cost, it's not showing me what I need to see. This isn't showing me either. One contract. This is showing the actual value of the contract. This is showing the expiration date. This is showing what they paid for that contract. So it's $1.70 per contract. So $1.70 per contract. Now it's trading at 14.7. And so that's where you get that 764% return on investment from. So you take that 1.7, you times it times 100. That's going to give you the total value of the contract. 1.7 times 100. I want to say it's about $170. So $170, they turn into $1,300. Pretty damn good ROI. You ain't getting that with penny stocks. So as the value goes up or down, that contract is going to grow in value exponentially. Why are options powerful? One word is leverage. Why is real estate powerful? Because leverage, you can control a multi-million-dollar property, $1 million property, a $500,000 property for 3.5%. And some people even do it with no money down. So that's what makes options powerful. That's what allows you to make good money. That's what allows people to make good money in real estate. And so you have to utilize the leverage that come with these particular things. Yes, there's risks. There's risk with everything. We're going to talk about mitigating your risk later on. So 100 shares of Spotify, normally at this price, I'm not sure what it is right now. Where did my thing go? If you were to buy 100 shares, back in the day when I was swing trading my entire portfolio, I had to buy the actual shares. With options, you can control the same amount of shares for a fraction of the cost. So an example of that would be 100 shares of Spotify. 100 shares would cost you about $28,000. But I bought this contract that allowed me to control 100 shares of Spotify for $1,000. $1,000 approximately. Average cost was $9.20 times 100 is going to be about $920. Now, that $1,000 contract allows me to control $28,000 in stock. But another thing that allows me to do is not risk $28,000. And this is very important because a lot of people, what they do when they look at the risk in terms of options, because yes, your contract can expire worthless. Yes, your contract can go to zero, but now we're looking at $1,000. So let's say worst case scenario, Spotify drops 20, 30, 40%. Worst case scenario, very unlikely to happen. 40% of that 2,800 is damn near like $12,000. So you will lose $12,000 if you were to have bought $28,000 worth of it and it dropped 40%. Granted, if you have this $1,000 contract and it drops 40%, you lose $1,000. On the other hand, if this contract is successful and let's say it goes up 10%, 10% on that 2,800 is 28,000 is $2,800. That same $2,800 is going to go to you as the holder of that contract. So now that $2,800, this is approximate math, that $2,800 on your $1,000 investment is damn near a 200% ROI. If not a 300% ROI, it's 300% ROI. It's damn good. And that's why you can get these great wins. So the upside is massive. You turn a 10% return into a 300% return. And so you're earning on your 100 shares, not the $1,000 investment. The $1,000 investment just allows you to kind of tie up that. So I liken stock or options trading to real estate wholesaling. Real estate wholesalers are going to pay you a, what do they call it? A earnest money deposit that you can't get back. If you don't close that deal, guess what? You ain't getting your money back. It's non-refundable most of the times. They're going to pay you that earnest money, and then they're going to tie up the contract, and they're going to sell it to an actual investor. And that's how they're going to make their money. And the same thing is true with options. When you do sell, you sell the contract. You actually sell the stock. So like I said, you have exponential upside. Small money can lead to massive money. And so this is why people ask, how much money do I need to get started trading options? I recommend that you don't start trading options with any money. I recommend that you start trading options with paper. Please trade paper. It's just as fun. I guarantee you. When you hit a successful trade, you might not get the $2,800, but you get the skill set of knowing that you know how to make $2,800 in the stock market. And that's invaluable, especially as you get repetition and you start to do it over and over and over again. Now you have a skill set that's going to allow you to print money. Another thing is that most people, they never had the kind of money that they're making when they started making money in stocks. I wish I had my testimonials. I'm going to do that next time. I'm going to add my testimonials in here. And so people can see these really cool videos of people who have made a bunch of money trading options. I know Kid Killy, he paid off his student loans. I know people who have just done amazing things, started businesses, started candle companies. They've taken their options trading. I know, man, my neighbor I have a video of this. My neighbor, I was riding my scooter. I have an electric scooter. I was riding my scooter through the neighborhood, and I get stopped by this guy. He just yells out, "Todd." So I go over, and he's like, "Man," he's like, "Yeah, I bought your course. Options trading gave me the money to help put down on this house." And I was like, "Wow, that's crazy." That's that legacy stuff. But that's the power of it. If you harness it, if you get in the weeds, if you really go after it, you can make life-changing money. And I just executed a trade today. I'm going to show you guys later in this conversation that will show you that. One of the reasons why options are powerful is the limited risk factor. We discussed this earlier. You put up $28,000 to buy Spotify 100 shares, or you can put up $1,000 to buy a contract that allows you to control 100 shares of Spotify. You only lose what you put at risk. With actual stocks, I was risking my entire portfolio, and it hurt. Man, one time I had my entire portfolio invested in Bank of America stock. I'll never forget. It was the worst trade I ever took. And this is when I was like sold on options. I put my entire portfolio, and they missed earnings. I think it dropped like 15, 20%. I had everything invested. I was like, bruh, I'd never lost this much money overnight in my life. And that's when I became sold on options. Like, I'll never again put my entire portfolio behind one position, because we all know that you're supposed to diversify. My main portfolio is in around 7 holdings. I don't want you to build a mutual fund, but I want you to be diversified. And so that was when I was sold, is I'm not putting everything on there in one stock unless I'm limiting my risk by trading options, where yes, the contract can go to zero, but it's unlikely. It's unlikely that, well, I won't say it's unlikely. The contract can go to zero, but if we can extend the window, which we like to do, then if you extend the window of expiration, now you're buying yourself time. So the contract costs more, but you're getting insurance on your contract. Again, aim small, miss small. If you ever watch the movie The Patriot, that's kind of the motto. I like taking, look at that. I like taking smaller positions, especially when you're starting out, especially when you're trading. So then you can just get used to seeing that return. We want to focus on the percentage more so than the actual dollar amount that we're making, because as the percentage becomes consistent, and as you start to see that number is consistently large and is beating what you would make if you just were to invest in the flat stock market, which is what I call it. Now you can start scaling your positions. And so you get the skill set, you start small, you start with paper, and then you start trading maybe $100 per trade just to get into the trade. And then as you start getting better, now we can move to $1,000 per trade. Now we could consistently trade $1,000. Maybe we go up even higher. But I want you to aim small so that you miss small. Got all this stuff over here. Are you guys still with me? Can you hit a 1 in the chat if y'all still with me, man? If you're still in the chat and this is making sense, if this is making sense, drop a 1 for me. If this is making sense, drop a 1 for your boy. Shout out to David Hicks. Shout out to Morgan. Shout out to Brandon. Shout out to Bell. Shout out to Marquise. Shout out to Lysandra. Shout out to Special. So there are a few stock investing strategies. We have momentum. We have buy and hold, long short equity, index fund, pairs trading, contrarian investing, which is one of my favorites, growth, and value. Momentum is when you get behind a company that's just been thriving. An example of that might be Amazon. It could be Tesla. It could be Apple. It could be these large companies that are doing well. The ROI, I don't know what the ROI is. I think we said like 300% on that trade. So momentum investing, a lot of times what you'll see is these large companies that just don't seem to be stopped. And this is why I tell people in the course that the trend is your friend. You want to figure out what that overall trend looks like. So yeah, we want to zoom in and we want to see that small, maybe day chart, that 5-day chart, but I also want to zoom out and see the bigger picture. So where this is relevant is in a company like IEP, where IEP trades kind of stable, but if you look at the long-term 5-year chart or the overall all-time chart, I like all-time charts too, because it's going to show you how well that stock's been doing over all time. Now you're going to see like, okay, well, this might be doing well temporarily. It might be a fluke. Overall, this company is a dying company. Momentum is going to show you that, let's say you're looking at a company like Amazon, who's going through a small like blip right now, but the overall trend is upward and to the right. Upward and to the right is your friend. That's momentum. Buy and hold is more passive investing. That's just buying something and waiting. I personally don't like buy and hold. I have somewhat buy and hold positions, but I would consider them more momentum and value investing. But there's not too much I'm buying and holding forever outside of my dividend plays. So there's a combination of like dividend investing and buy and hold kind of go hand in hand. Especially if you have a high quality company, you want to protect your principal because that's a part of investing. We want to beat inflation, but we also don't want to buy something that's going to be here today and gone tomorrow. Index funds, pairs trading, contrarian investing is basically going against the general market sentiment, buying when everyone is selling. One of my favorite forms of investing, and that's why I'm getting excited in 2022. And I'm looking for opportunities to invest in 2022. Sometimes you got to take a break. 2021 was kind of a break for me because the market ran so high in 2020 and kind of into 2021 that I was like, let's find reality. Let's find out what's really going on, what makes sense. And then when we find what makes sense, we'll hop into something because I don't want to buy something that's inflated. I don't want to buy something that's hyped up with treasury dollars or all that stuff. And that's what happened. And we're seeing the market correct down. The entire S&P is down substantially since that time. And so you're going to look crazy because sometimes you can't explain why something is doing what it's doing. You can't explain why the stock market is doing what it's doing, but you just know that there's a reason why it. And sometimes you don't have to explain. You just got to know, like, okay, the market did really well in 2020. It's likely to correct in 2021. Let's position ourselves so that we can do something intelligent in 2022. And then maybe you might not find the bottom. Maybe you find something better, like closer to the bottom, but still that's better than you chasing tops and trying to chase high flying stocks. When everybody's excited, when everybody's sharing stuff, I get nervous. I don't want that. Growth stocks are going to be those companies that are up and coming. I would say maybe something like a Uber, maybe something like an Airbnb, those recently IPO'd companies. Those are kind of like more of your growth stocks. You got to have patience with those things. Yeah, they might be struggling right now because a lot of these IPOs, they debut very high. So if you saw Robinhood, it's getting hammered today in the stock market, but that was once Amazon. That was once Tesla. Amazon went unprofitable for decades, and they were making fun of it. They were saying, it's not a good company. It's not a good stock. And then it blew up. And so that's why when you see those people talking about like, oh, if you would have bought Amazon and 20 years ago and held on, like, yeah, you know what they were saying about Amazon back then? They were saying crazy stuff. Why would somebody want to buy books online? Why would somebody want to do this and get it shipped to the house so you can go to the mall? And so you have to see through that stuff as an investor. You have to see through and have some vision when you're an investor. And that's a lot of what value investing is. Value investing is when you can see what's going to come before it's here. Value investing is when you can see that what the media is saying might not be true. And that's a very controversial statement to make because a lot of people, what the media says is gospel. But as investors, we have to see life as an investor. We have to see through what people are saying. So I look kind of crazy and maybe like a jerk when like the news says something and I'm like, nah, I'm not feeling that. But I look very smart when my investments in MGM and AMC and UAL and what else? DAL all come to fruition. I look like a genius when I'm getting 100% returns on Red Robin Gourmet burgers. So I would say that those are the different stock investment strategies. Let me see where we are in these notes. All right, we're getting close to the end. So here are some mistakes that a lot of people make when they start trading. A lot of people start with too much money. And this is why I told you guys to start with no money. Start learning, get your skills up. And then when you do start, I still want you to keep your position small. You want to have that small trading kind of strategy. That's okay. It's okay to start small. You guys, it takes 18 years to become 18 years old. You aren't born and start dunking basketballs. When you're born, you're going to have to walk first, baby. You have to probably crawl before you walk. But don't nobody want to crawl as a trader. Everybody want to just get up and start sprinting. And imagine if you are a baby and you got up and start sprinting, you probably get frustrated because you never learned how to crawl. Crawling is okay. And crawling is going to allow you to walk. And walking is going to allow you to run. And running is going to allow you to jump. But you got to work the process, you guys. You got to play the game. You got to trust the process as well. So if I'm telling you to paper trade and paper trade and paper trade and paper trade, and you're mad at me because I'm not telling you how to make money, I liken that to Mr. Miyagi. Mr. Miyagi said, wax on, wax off. Y'all don't want to wax off and wax on. Wax on, wax off. Paper trade, trade one index. Paper trade, trade one index. Paper trade, trade one index. I'm not telling you this because I want you to stay paper trading and trading an index. I'm telling you this because I want to get you the skills of your hands. I want to get you the skills of seeing what's there. I want to get you the skills of generating the ability to really understand it. Technical analysis, fundamental analysis are very difficult, and you're going to have a very difficult time when you're trying to look at a million different charts and do technical analysis. But if you can look at one chart and one chart only, you can draw out your support resistance, you can check out your indicators, you can draw out your trend lines, you can read the candles, you're going to be so much further ahead for it than if you would have just jumped into it. So don't just jump right into it, guys. Trust the process. Wax on, wax off. Man, this is important. Believes that a low stock price equals cheap. If you guys look at the stock market, I always tell people that don't focus on the stock price, focus on the market cap. The market cap is going to tell you way more than the stock price. There's banks that trade at $100, $200, and there's banks that trade at $9 and $10. You want to look at the market cap, but you also look at the PE ratio. The PE ratio is when you take the price of that stock and you divide it by its earnings per share. Why is that important? Is it's going to give you a multiple. So a lot of times we talk about business acquisitions and use a multiple. That multiple is going to tell you how many times earnings that company is worth. Now, what do you do with that information? You take that information and you compare it to other companies in that sector. So companies are part of sectors. You got banks, you got retail, you got healthcare, you have pharmaceuticals, you have tech. All those companies are not created equal. You got to compare apples to apples. When you're doing your fundamental analysis, you got to compare tech companies to tech companies, and banks to banks, and retail to retail, and car companies to car companies, unless that car company is Tesla, because Tesla's not really a car company. It's more like a tech and energy company. So just because the stock price is cheap doesn't mean that it is, just because the stock price is low doesn't mean it's cheap. This question says, what is a good PE ratio? That is determined by the sector. And so you're looking for the average of the sector, and then you're looking if companies are either trading higher or lower than that. Sometimes that's a good thing because sometimes what we're looking for is the best of breed in terms of these stocks. So if I'm looking at like online retail, if I'm looking at, what am I looking at? Car companies. I want to find the best car company among the car companies. So, and a lot of this is subjective. So like the word good depends. So what you want to do is you want to compare it to the industry. And then also you might be able to Google like what's the average PE ratio for car companies in America 2022. So that's going to tell you that. Another thing is panic sell. I'm not going to panic sell during the market crash. We know that. Falls for FOMO. A lot of people see these stocks flying down the timeline. You got to do your own due diligence. You got to hold on and you got to see what makes sense to you. Another thing is waiting for better times. So many people say they're going to invest when. I'm going to buy stocks when. And you know what happens? When never comes. The best time to invest was 20 years ago, and the second best time is today. And that's why all the skill set that I took when I was investing the penny stocks and when I was making those mistakes buying tops, those all made me better now. So because I started investing then, I'm better now. Yeah, that was 10, maybe 15 years ago, but I'm better for it now. So you should be starting to invest now instead of waiting for better times. I don't even care if that was 2021. So be it. I don't even care if that's 2022, especially now because the stock market is corrected so low that a lot of times what happens with the stock market is it overreacts to news. It overreacts to good news. It overreacts to bad news. Your responsibility is to consistently invest and stay the course because you're going to continue to spot opportunities as you go along. And another tip is to continue to put new cash into the market. Don't just set it and forget it. Myself included, I like to invest money and just wait. Don't do that. Consistently invest, systematically invest. Make this a process and a procedure in your life so you buy something and you continue to buy, and you continue to buy, and you continue to buy, because one of the best ways to create a portfolio is over time. And investing is a great way to trick yourself into saving. So, what are some ways to trade options safely? Practice. That's the way to do it. Practice. Another thing I would say is you want to trade with a group. There's a ton of Discords out there in the streets these days. So you can join a Discord. You can join, I think that's probably the best way to do it. You can join message boards, maybe Reddit, whatever's out there. But get in these Discords. They're going to be telling you all of us can't watch every stock on the stock market, but all of us watching different stocks, now we have eyes on the stock market. And that's why these discords and these groups is so important. So I'll be a part of a group. Another thing is focus on the same stocks or index over and over and over again. Don't chase every ticker on the timeline. Stay the course, trade your index, whether it be the S&P index or the NASDAQ index, or maybe even the Dow Jones, but the Dow Jones is going to move kind of slower. Not that sexy. Let's focus on the S&P, which is SPY, and the NASDAQ, which is QQQ. And other companies have different tickers for the same thing. Other companies have their own index fund. When you do eventually go live, stay small. Don't rush the process, because if you rush the process, you're going to get frustrated and you're going to quit the process. And I promise you, if you get to the point where you're doing this well, you will make more money than you ever thought you could. So trust the process, stay small. Another thing is keep a trading journal. I don't know why, but it's very easy to forget trades that you get into. It's just easy. I do it all the time where I will like have a successful trade and then I'll move on to the next trade and I would have forgotten like all the other previous trades that I had that were really well. They're really good. And so why is that important? It's important because sometimes you need to pick yourself off the ground. You might have a bad trade, 2 trades in a row, and then you start thinking it's not for you and you forget you had 15 trades you did really well on. Well, let's give ourselves that pep talk and let's also look at what we did right there and what we did wrong here. I find that sometimes my best trades when I've taken a break from trading. I take a break and I come in and I hit a home run. I don't know why that happens. I'm still trying to figure it out, but I just know that sometimes I think once I do get that trade, I try to rush the process. So when I get back in the game and I do well, then I start kind of just trying to gamble a little bit like, oh, let me put some money over here, put some money over there. I don't do my proper due diligence. I just like, I got to get in this. I got to make some more money. I don't think that's the smart way to do it. Make every trade like your first trade, like Biggie said, or Jay-Z said, I treat my first like my last. So treat your last like your most current trade like your first trade. The same due diligence you put into that first trade, put it into every trade. A few trading styles are scalping, swinging, intraday, and position. This is important because you're going to hear these terms thrown around. Scalping is quick in and out, minutes, maybe hours. Swing trading can be a little bit different. Swing trading can be sometimes I'll trade like from the evening to the night if it's an earnings play, or early in the morning to the end of the day, or just for like an event. If you know an event's coming up, if you know that they're going to be releasing a new product, things like that, you can swing the trade through that. Intraday is just trading through multiple days, and then position trading is just long-term hold on your trade. You can use the vehicle. So the stock market is just a vehicle. You can use the vehicle to get wherever you want to go. Some people scalp, swing, intraday, position trade. You don't have to pick just one, but be aware they exist. And also, I like to say take a hybrid approach. So what's cool about the hybrid approach is you're not dedicated to just one strategy, because something might make sense in that moment. It might make sense to scalp in that moment if you're seeing a lot of maybe volume or a lot of momentum behind that position, but it's not something you want to be in long term. Or if the long-term trend isn't favorable, then maybe you want to kind of just get in really quick and make some bucks. Trading earnings. I love trading earnings. I do. Ooh, and I don't care what nobody says. You want to know why? Trading earnings doesn't always work, but when it does work, you ain't never made more money in your life, man. I've seen people make $100,000 on the earnings trade. I saw somebody make $1 million in the earnings trade. I'm not sure how legit it is, but I'm just telling you what he told me. So take that with a grain of salt. But last week I saw somebody make $1 million on an earnings trade. And what's interesting is all stock markets aren't created equal. So we went through a time period in 2020 when the stock market was down, but it wasn't down for what I deem fundamental reasons. It had nothing to do with the actual company. It had everything to do with the macroeconomic system. So we had a situation where the whole country was shutting down. And so great companies are trading low. So the problem with that is great companies are trading low. They're still reporting great earnings, but maybe the outlook's negative. Maybe their forecasts are negative. Maybe what they're expecting to happen in the future is not working out that well. That can impact that. But in a traditional, normal stock market, good companies report good earnings and do well following that report. Bad companies report bad earnings and do poorly following that report. sometimes companies can become overvalued. And even if they report good earnings or they're overvalued and they report bad earnings, that's a recipe for puts all day. We're going to buy puts on that all day. Or if it's a good company trading high, even if it reports good earnings, it still might not win because it's already been baked into the price. So that's really important. Trading earnings is good because of the high volatility, the high probability of the trades. It eliminates the guess factor because one of the most important things with options trading is time and knowing when the move is going to happen. Not just know that the move is going to happen, you got to know when it's going to happen. And we know when earnings is going to happen. This calendar that you see right here, they're telling you on this day before the open, UPS is going to report earnings. On this day after the close, Apple's going to report earnings. They can be unpredictable because you could do everything right and still miss, but that's, in my opinion, not a bad thing. You just got to stay the course to continue to trade your plan. Sometimes the stock market's just erratic. So somebody asked me today, they said, how'd you know that was going to work? I didn't know. I just put a bunch of things together and I made an intelligent decision. But you never know. I don't think it's possible to know what the stock market is going to do. Anybody who tells you they do is probably not being 100% truthful with you, because the stock market has a mind of its own. Over time, I can tell you anything the stock's going to do, but short term, you never know. Nobody knew we were going to be dealing with this Russia crisis. Nobody knew inflation was going to be crazy like this, but that all impacted the stock market. So it's like, how can you be Negro Damas? You probably can't. So tools of the trade, you're going to need to know your indicators. Technical analysis is very important, especially if you're trading. You're going to want to know your chart patterns. You're going to want to know your support and resistance. But then you're also going to want to use these tools that are actually called indicators. So you have the MACD, the RSI, Bollinger Bands, moving averages, which I love. And then those down there, I don't really use those too much. But the best thing is to pick a few and run with those. Don't have your chart all filled with indicators and moving averages, fam. Get you a few, run with those, and those are going to tell you a lot. So, but it is important to know those. But as you become a better trader, you're going to rely on these indicators less and less. But what a lot of people like to do is they like to find the indicators and think the indicators are going to do the work for them. But a lot of these indicators are lagging indicators, meaning that the information that they're telling you is information that happened in the past. In the past, sometimes the past is not always an indicator of future results, is the phrase. So you got to take that with a grain of salt. Can it be helpful? Maybe, but it's not gospel. Man, I'm coming to the end. And the last thing I would say is focus on what you can control. Your exits, your entries, your mindset, your work ethic, your time frame, your confidence, your screen time, your belief system, your position sizing, your reaction to news, your emotional reactions, who you listen to, and what you don't control is price action. So that's what I told you. How did you know Amazon was going to tank? I didn't. But based off of what I'm seeing here, based off of what I've seen in the last 3 months, I'm going to go over that in a second. That's how I kind of had a feeling it was going to correct. And I just made an intelligent decision. I didn't predict the future. So in 2022, I think we're in a unique position because I feel like the stock market is starting to kind of return a little bit. We saw a really good day yesterday and a really good day today. When I say the stock market ran up maybe 500 points, when I say the stock market, I'm talking about like the Dow Jones, which is generally what we deem the stock market, or the S&P. So yesterday was a good day. Today was a fairly good day, but this is after, I want to say, a terrible last week. It just wasn't a good time. So one of the most important things is your position sizing, especially when it comes to options trading. You minimize your risk by watching what you put at risk. Do not get into a heavy trade. Do not trade a bunch of money, because that's how folks get clapped. And you have to remember this rule even when you make a bunch of money, because you're going to make a bunch of money. And you're going to think you're Jesus of stock market investing. You're going to want to say like, oh, well, shit, if I made 10,000 off of 1,000, what can I make off of 10,000? You can lose your 10,000. That's what you can do. So what you need to do is stay the course. If you make 10,000 off 1,000, let's put another 1,000 to work and let's make another 10,000. I've seen too many people make a bunch of money and lose a bunch of money because they started thinking they're just that N-word, and you gotta trust the process. The next thing is focus. Focus on one stock if you're going to trade it and know everything about it. Everything about that stock. Today, I own a company named IEP, and I Googled the CEO. I was like, what the heck? Who am I to not know the CEO of this company? This company is paying for my child's education. That's kind of ignorant for me not to know the company, the CEO of this company. So I Googled him, I read his bio, and I was like, all right, that's what's up. And so then I also did a little bit more digging to see all the other companies that this company owned, which is important. So it's like you got to dig in and you got to find that stock and own it. And that's as an investor or even as a trader. You got to own it. I would say in terms of owning a stock, if you're trading it, we need to dig in and we need to understand all the technicals that are relevant to that stock. So you need to know where it is in terms of supply and resistance. You got to know those supply and demand levels. You got to know that because that's going to allow you to get in and exit the trade. That's really important. Support and resistance. We're talking about trading the range. This is the easiest way to trade. This is the way most people teach how to trade. It's real simple. You're looking at where the banks are buying, where the banks are selling, and that's how you're planning. You're just moving along with the smart money, as they call it. So smart money is selling here, I'm selling here. Smart money is buying here, I'm buying here. And just go with that. No ego involved. Don't try to outsmart the market. Don't try to outspin these big ballers in the stock market. And that's what happens when you see supply and support and resistance. Some people call it supply and demand. You want to trade that range. Man, we're coming up on time. What time is it? The last thing is patience. Trust your gut and don't get shaken out of a position. If you bought it based off of that support level, hold it. Don't overhear. You made a little bit of money and now you're scared you're going to lose it all and you exit that position. Trust your gut. Trust your analysis. Trust your due diligence. The other thing in 2022, I would say is seek value. Find great companies with bad press. And a lot of times that press is bad. I can't think of anything right off the top of my head, but I mean, Boeing is always going through stuff. Boeing had that accident recently. That's opportunity, y'all. Bad news is opportunity as an investor. This is true in real estate. This is also true in the stock market. If it's bad news, it's usually an opportunity because you can find a discount. You'll make our money on the buy. You're going to make your money when that price dips low. And usually the price dips low when everybody has something bad to say about it. That's when you get in Facebook. Exactly. If you bought Facebook off of that dip, you're looking like a genius. Other thing is play politics. You got to know what's going on and what is to come because those matter. They might not happen immediately because the government moves very slow, but it's important to keep up with current events and the news to know what policies are happening that couldn't impact your investments. And then the last thing is you got to treat it like a job. So you got to treat it like a job if you want to make some dough, in the words of Larry June. That's what he said. Really quick, this is a recent trade that I actually did today, and I just kind of want to talk about why I got into this trade. So this trade is on the S&P index, SPY. I told myself I'm just going to focus on SPY for a little bit. So I charted it out, and I saw these baselines right here form a support level. And then here, this term is a resistance level. And so what you want to do is you kind of want to take the predominant tops and bottoms. So there's two large tops, two large bottoms. I was like, all right, I feel like this is a support level. I bought it down here, and then it ran up. And then I'm still kind of holding it right now. So far, that trade's made about $5,000. So this is why technical analysis is important, but this is also why zooming out on the chart is important. Because if you look at the short-term trend of the S&P index, it's actually on a downtrend. And if you look at like the year chart, it's on a downtrend as well. But I found a good chart that had a good range and kind of told me what I needed to know. And yeah, that provided me an opportunity there. Is that opportunity always going to be there? We don't know, but we have good odds if we buy where the banks are buying, and it shows buy, that this is a good kind of range or window to buy there. The other is the Amazon trade. So I bought puts on Amazon. The reason why I bought puts on Amazon is because it was trading pretty lofty. You see a short-term kind of downtrend over the past year. It's down 23%. But what was really cool about this chart is I saw like a triple bottom. So there's a bottom there, and a bottom there. And usually that's bearish. It's like they're trying to push through that kind of floor. So I bought puts, and it's down about $300 per share. So when you're looking at technical analysis, a lot of times you're just kind of like having different things in your pocket, and you're looking for different things like, okay, we're going to draw the trend lines. We're going to draw some support and resistance. We're going to look for any chart patterns. head and shoulders, double tops, double bottoms, wedges, flags, all that stuff is going to help you kind of determine what's next. And so there's flashcards out there. I recommend you print out. You can usually find like a technical analysis cheat sheet and just print that out and just study it. And you might not get it immediately, but over time, it's going to start to come to you and it's going to stick with you. And the last thing I would say is trade what you see, not what you want to happen. Can't cover everything. There's a lot that goes into this. I kind of break this deep into the course. You can grab the course. There's probably a sale link in the bio. And yeah, people are doing some really cool stuff with this stuff. I'm just kind of blown away at the results that other people are getting from the content that I put out years ago. But man, people not only have taken my content and made money, they've taken my content, dropped their own courses, taken my content, created their own communities. So it's kind of cool to see what we've created just off of some information that we put out there. I think the information will be valuable to you as well. So grab it now. If you're on Instagram or Twitter, I think it's only like 10, 20 bucks. So if you can catch it there, get it for the low. If you get it in the link in the bio, I would say use code 80, EIHTY, and you'll get a significant discount on that course. I look forward to working with you. We also have an option trading community. We also have a Freedom Pack family where if you guys have bought any of our courses, you have access to that. To ask questions, we have conference calls every day at 7 o'clock, but we're going to be trading that into 8 o'clock. And yeah, tap in with us. We out here. Answer this one quick question, and then we're going to wrap. I'm ending Instagram live though. So this question says, what percentage of day traders are successful? In my opinion, I would assume most fail and learn how to trade options properly and efficient. Most people do fail as day traders. And I don't want you to be a quote day trader. I don't want you to be necessarily a day trader, but I do want you to have the ability to trade. So don't focus on being like a day trader as like a profession. Focus on just making good trades. That's what I would say. Focus on making good trades, not being like an actual day trader per se. And I think you'll find success if you have more patience with yourself, because really it's just a way to supplement your income. I don't want you to try to replace your income until you get that good. But I think a lot of people who quote fail, they just give up too quick. It's kind of like golf. I've been golfing a lot lately and my driver was on point, but my short game was struggling. And so I focused on my short game and then my driver went out of whack. And so I went out and then I played and all my stuff was out of whack. My irons weren't hitting. My drive wasn't hitting. And I was like, you know what? I got to get in the lab and I just got to hit as many shots as possible. I bought 2 buckets and I just started swinging until I couldn't miss. And so like a lot of us, we just want to get it, but we don't want to put in the Kobe Bryant work. We don't got that Mamba mentality. So you got to approach everything with the Mamba mentality. And I promise you, forget about the people who aren't successful. Just focus on you becoming successful. And if you put the time, and that's why I said focus on your why. If you put the time and you have a why and you focus on that, you will see success. It might not come immediately, but it'll come eventually. So, let's see something. I wonder if I have a link to this. Let me see if I got a link. Should be around here somewhere. Is it here? There we go. All right. So I'm gonna shoot you guys this link. You can get the course for just $10 if you grab it right now. This question says, you bought May 22 calls. Are you swinging or day trading? So one of the principles that I abide by, and I go over this in the course, is usually when I'm trading earnings, if I get profit, I'm taking that profit. Why? Because it was a short-term position. My exit was based on the time period, not necessarily a price. So a lot of people think that the X has to be based on like a price. I think sometimes the X can be based on your time if you're buying it based on that time. So with that, I bought it longer just in case it didn't pan out, because sometimes what happens if you have a high quality company, it can report earnings and it can dip even if it's still a quality company. You want to give yourself some time to ride that out. One of the textbook examples of that is Netflix. Netflix is a company that they tend to miss on earnings and then they correct afterwards. It happens all the time, sometimes in the same day. And sometimes it takes some time to creep back up, but it eventually returns. It's not there yet. It's still been trending down, but they're getting hammered right now. So traditionally, Netflix is one of those companies. So pleasure talking to you guys all. I'll have the replay available, and check your emails for that. We out.